Introducing BONARD platform, the gold standard for global student housing intelligence. Access a world of data, from general country and city overviews to targeted asset and location insights. Instantly benchmark, analyze, and compare an extensive database of over 260 markets and 14,000 PBSAs, available 24/7. Discover opportunities with our interactive tables, graphs, and maps. Simply click, drag, and explore. Every asset, every opportunity, visualized all in one place. With the most extensive database for student housing intelligence, including assets, market demand, supply, rent, pipeline, transactions, yields, and portfolios. It offers unmatched market insight depth. BONARD platform, where data meets opportunity.
Good afternoon to everybody, or morning or evening, depends on which part of the world you are watching our webinar. Welcome at the traditional student housing annual report session, where we will present student housing annual report, followed by expert panel to comment on recent developments in student housing. My name is Samuel Vetrag. I'm the CEO of BONARD, and I will make a couple of housekeeping notes at the beginning, and then I will pass on to my colleague to present at about 20 slides on student housing annual report, where this year we have about a few new KPIs on portfolios, rents, pipeline, but normally we have all the other KPIs like demand, supply, rents, yields, pipeline that will be informing you what's going on the market, or what's going on last year and is about next year. So Martin will present, my colleague, in about 20 minutes. And then it will be followed by roughly 60 to 70 minutes of expert panel session. We will also have a few polls during the course of conversation so that we have interaction with the audience, as well as some feedback from the market instantly for all of us, so that we can have a sort of informed session. This session is recorded, and both the recording and the annual report will be delivered to all who registered to this webinar. We have about 1,200 registered participants of this session, and which represents roughly 750 companies from different parts of the world, from 57 countries, while 67% is from Europe and the rest is Americas, Middle East, Asia, Australia. Roughly 51% of the audience are investors and financial institutions, 12% are developers, and 11% are operators, and then all kinds of other stakeholders in the audience. So I hope this report and Martin's presentation will be useful to you. Martin will present directly from our real-time access interactive platform for student housing with data available globally. This platform is used now by more than 200 clients that are using it on a daily basis. And this platform is normally in daily life used for assessment, investments, or transactions. So Martin, over to you to present on what was going on last year.
Thank you, Samuel. And first of all, good morning, good afternoon, good evening to everyone. It's my absolute pleasure today to guide you through the last statistics, key trends, and the figures for 2024 with a comparison to the previous year. As we discussed previously and we benchmarked previously, we're going to be focusing on Europe as well as Canada and Australia. And as per previous year, also today, and as Samuel mentioned, we'll be utilizing our data platform for the presentation. So we could benchmark the key metrics on both city and country level and providing you with an updated report afterwards, which will be distributed or able to download on our webpage. For those who are not familiar with the BONARD, we are a leading data platform and a research firm offering subscription-based access to our comprehensive database and interactive platform. Our tools are designed to support feasibility assessments, market evaluations, or underwriting processes. The platform covers more than 260 cities globally, with more than 2.4 million beds across 14,000 public and private assets. In addition to student housing stock, we also track pipeline data, rental trends, amenities per asset, services per asset, transactions, and much more. And as part of the platform, but also as a complementary tool, we have a market monitor feature, which provides daily updates across various living sectors on a global scheme. So should you wish to be up to date and have daily update what's happening in student, in BTR, or other living schemes, feel free to subscribe using the link that you can see on the bottom of the screen. Our clientele, as you can already see from some of the examples here, includes institutional investors, private equity firms, asset managers, funds, pension funds, developers, banks, operators, and many other key market players. And with access to our platform, we enable these stakeholders to fast track their decision making by leveraging our reliable and consistent data. All the data that will be presented today, as already mentioned, are sourced directly from the platform. And should you wish to explore it and to check the data further, I'm kindly inviting you to visit our webpage, bonard.com/platform, and get a free 14 days access so you can experience the platform yourself and access the full database across multiple countries, cities, or assets. And now about the student housing sector and student housing asset class. The past few years have presented some challenges, mainly due to factors according to macroeconomics that have impacted underwritings as well as investment activities. And as we saw across the real estate, the transaction volumes in many sectors remain stagnant. However, when comparing student housing to other real estate asset classes, PBSA sector has captured more and more investment and investor attention, and you can also see it in the ranking in front of you. It has become increasingly attractive due to its strong fundamentals like rent growth, stable occupancy rates, as well as the sizable demand-supply gap, all of which provide opportunities for above average returns and higher IRRs. So now let's dive into the key statistics from our annual report, starting with demand. Specifically, we are looking now at international student numbers. As shown here, we have outlined selected top destinations and their ranking for international students across Europe, Canada, and Australia. The international student population continued to rise across most cities included in the report, with an average growth of 2.8% compared to the previous academic year. However, some countries, such as UK, Canada, and Australia, have introduced policies to limit the number of international students, as well as we are closely monitoring the potential shifts in the US. But even looking at all this, and despite these policy changes, we do not anticipate a decline in any international students' demand overall. Instead, we expect the student flows to be shifted to some extent and towards the destinations and study destinations that will be offering a wide range of English programs and degrees. And following that, this could boost the development of the student housing sector also in other alternative destinations and countries. Turning now to supply. From the ranking and statistics, we observe that London and Greater London continues to dominate the private student housing market, and it's followed by the Greater Paris and Melbourne. This ranking remained relatively stable compared to the last year. However, what is interesting to see are the trends in the various contract lengths that were offered in 2024 versus the offering in 2023. You can see the percentages on the right side, which represents how many of those residencies that we monitor are offering different type of the contracts. So now the total ratios. The most common contract length offered in 2024 was 10 to 12 months, which basically is in line with the duration of the academic year. In Australia, as you can see, the shorter contracts remain the most frequently option that were offered by selected providers. But what was interesting to see was the rise of the longer contract in terms of 2024, namely 13 to 24 months, as well as 25 months plus, which are those two. Looking in 2023, those offerings were only at the level of 2%, versus 13 and 17 in 2024. Meanwhile, in Europe, we saw an increase of short-term contracts opposite Australia. If we compare it to 2023, and to be more exact, we saw 16% more residencies offering contracts between 1 to 3 months, and 11% more residencies offering 4 to 6 months options. Looking in Canada, however, the trend remains and is leading towards maintaining the majority of the offering only within the 10 till 12 month range. Provision rates. We basically continue to see significant gap between the demand and supply in many of the most student cities. The number of international students, as well as number of the domestic mobile students, is growing faster than the number of the new PBSA beds that are coming to the market. And this gap is also expected to widen in the midterm, leading to notable shortages in the key student hubs. As seen here, the most notable improvements in the provision rates were in Lyon and Frankfurt. And the rest of the market saw relatively modest improvements. Interestingly, despite London having the largest number of the beds, of the private beds available, the provision rate decreased compared to the last year. And this factor, as well as the latest statistics, highlight one of the fundamentals of student housing, that supply is struggling to keep up the pace with the demand, which continues to lead to market undersaturation. And in fact, the provision rates declined in 27% of 186 cities that we monitored, while only grew in 24 of those cities. Having such a pressure from demand and lower offering from the supply, we can basically say that the average occupancy rates in 2024 was 97% and remained stable in the most countries that we analyzed. Occupancy declined only in a handful of the countries, like Italy and UK by 2%, or Germany and Australia by 3%. Slight occupancy drop in the UK may be due to longer student visa approval times, while the rent increases in the other countries could be the contributing factor. On a positive note, though, occupancy rates were above the average in 56% of the countries that we monitored, so it was more than 97%. And looking ahead, how the situation is improving in terms of the stock, we identified a pipeline of more than 450,000 beds across 323 cities. If we compare it to 2023, this reflects about 20% increase. If we break it down, almost 2/3 of this pipeline were still in the planning stage, while the remaining 35% were already under construction. The most significant increase that we saw was and has been in Greater London in terms of both construction and planning stage. And it was followed by the Greater Paris, which recorded the second largest increase in beds that are under construction. If you look at openings, in 2024, 230 new purposely built student accommodation buildings were opened, adding a total of slightly more than 64,000 student beds across 131 cities. Looking at the numbers and the statistics here, Nottingham and Greater Paris topped the list with the most new beds coming to the market. But it's very important to mention that the number of beds completed in Greater Paris in 2024 was lower than it was in 2023. And also, if we compare the other student hotspots like Amsterdam, the new supply slowed down, and only one building was completed in 2024, versus 10 buildings in 2023. And a similar trend was observed in the other cities like Warsaw, Toulouse, and similar popular student destinations. Looking in the portfolios, and our platform provides the detailed data on all privately owned portfolios across Europe and Canada, including the portfolio sizes, territorial footprints, asset lists, ownership structures, list of the assets in operations and not in development, and so on. In 2024, we observed another period of expansion for the global PBSA sector, with the new operations and brands joining the market, and at the same time, existing operations expanding their portfolios. One of the interesting things to see was also the consolidation of existing operators in large brands that are managing more sizable portfolios, which might be a sign that the market is approaching some stage of maturity, and we can expect to see more portfolio transactions in the coming years. Looking in the UK, which currently is the most major PBSA market from the regions we monitor, the large operators dominate, and the brands with more than 10,000 beds make up to 64% of the sector. The continental Europe, a relatively less mature market overall, is catching up as well. In 2023, the brands with over 10,000 beds accounted for 29% of total offer, but their proportion went up to 34% in 2024. And comparing it all with Canada, Canada is market in still very early stage, being driven by local and some international institutional capital. So you can see the size of the portfolios are still much less than 10,000. But we've seen some significant movements also in Canada, including the recent acquisition. The Forum acquired Alignvest, making them the largest player in the Canadian PBSA sector, which was billion plus transaction. Now getting into rents. In 2024, we saw the largest year-on-year increase since 2018, mainly in the private single studios. The average rent for single studio increased by 7.4%, and it was 7% in 2023. Looking in the UK, the UK experienced particularly strong rent growth with an 11.3% increase. You can also see the ranking of those countries and their changes 23 and 24 on the right side. And it's mainly focusing again on the private single studios, which continue to dominate the market at the same time, remaining the most popular room type in the student housing sector. And interestingly, we observe the correlation between the room sizes and city tiers, and residences in tier 1 cities offer the smallest rooms, while the tier 3 cities provide the largest rooms in that context. However, comparing the room sizes of the single studio and the average room sizes 24 and 23, it remained quite consistent at a level of 19 square meters. Looking on the second graph, we can see the benchmark between the room sizes and the rents per square meter. Looking at it more closely, we can see UK achieved the biggest rent per square meter in the single studio product, followed by Australia with even smaller average room sizes. On the other hand, Denmark and Canada are the only two countries that achieve the average room size is bigger than 30 square meters. And with the Canadian single studio offering average rent per square meter at almost 42 euro per square meter. Transactions, and following a period of stagnation which started in 22 and continued in 23, we saw some transaction increase in 2024, and particularly in the final quarter. The total number of the recorded deals grew slightly from 50 deals in 2023 to 56 deals in 2024. However, the total transaction volume almost doubled in 2024, with an increase of 94% and a higher number of larger deals recorded when we compare it to the previous year, 2023. Despite these positive trends, the student housing yield development broadly continued on the same trend as in 2023, with an expansion range between the 15 to 80 bips, mainly due to high cost of the capital. However, considering the other factors like strong market fundamentals, economic outlooks, increased appetite of the investors, as well as student housing being one of the top asset class to look at and invest, it is reasonable to expect that the sector will attract more investments in 2025 and will have an impact on the yields as well. And this positive investment mood and optimism was also underlined with our investor intention survey. We We did it in 2024, and we surveyed more than 100 respondents that included investors, that included operators, developers, bank, and other stakeholders. And the main finding and the main message out of the survey was that 70 to 80% of those stakeholders are planning to invest more into student housing than they in 2025 compared to the previous years. All the data today, again, are presented directly from our online BONARD platform, which is designed for feasibility assessments, market evaluation, and underwriting processes. I encourage all of you to get a free access at bonard.com/platform and test it yourself. So feel free to access it and experience the platform.
Introducing BONARD Platform, the gold standard for global student housing intelligence. Access a world of data, from general country and city overviews to targeted asset and location insights. Instantly benchmark, analyze, and compare an extensive database of over 260 markets and 14,000 PBSAs, available 24/7. Discover opportunities with our interactive tables, graphs, and maps. Simply click, drag, and explore. Every asset, every opportunity, visualized all in one place. With the most extensive database for student housing intelligence, including assets, market demand, supply, rent, pipeline, transactions, yields, and portfolios, it offers unmatched market insight depth. BONARD Platform, where data meets opportunity.
And I'll wrap up here, and I want to thank you all for your attention, for joining us today. I hope you found this kickoff presentation useful, and I'm passing words back to you, Samuel.
Thank you, Martin. I will probably add a couple of the executive views after the data presentation. So from macro perspective, last year, as we all experienced, there was an economic environment change. Financing and borrowing become more relaxed. There have been more investments, especially in the second half of the year and Q4, and much more forward-looking mood or attitude from both investors and financing institutions. We started to feel the change of atmospheres sometimes at the end of Q2, where we had many more requests for data and reports. And then at the end of Q3, it was really a very different situation, especially after the change of direction in interest rates, both by Fed or ECB. Not to mention that when the ECB made a commitment to decrease the interest rates down to 2% before summer 2025, then it accelerated the demand for sort of data and then investments. As Martin mentioned, you must have seen all the articles and announcements, but student housing has become extremely popular investment asset class, and de facto become number one sizable asset class for investments on expense of, let's say, other asset classes like office, retail, or hotel. So we saw this in overall performance of the market. So as we as a data firm are usually at the beginning of a change, so we see the change of mood and attitude and purchases of data sooner than people invest. So student housing indeed was among the first ones from the asset classes that noticed sort of more investment appetite. And that was not only because of the macroeconomics, but also the fact that both rents and occupancies increased at the same time. Again, 3 or 4 years in a row, depends on the country. And some of the more mature operators already take bookings for 25/26 academic year, and the uptake is also stronger than the year before. Also, other factors were there, like rents, student housing rents increased again north of 5% in general. However, not as fast as the private rental market. So the other options for students, so if they want to rent in HMO or a flat sharing, it increased the rent even more than, let's say, PBSA residential accommodation, as well as the rents in PBSA did not increase as fast as the disposable income of their parents. So the rents have room to grow. The rent growth is probably sustainable for years to come. In some countries, like UK, the occupancies or the mobilization and consolidation of occupancies was not as fast as in the previous years, mostly because of the regulations. But they reached the same level probably a little bit later or at a higher marketing expense. That's what we hear from the market. Supply is not as fast with new deliveries as it used to be. So while the student growth is ongoing, but as we had the higher cost of delivery, as well as some other hindrances, the supply delivery was slowed down. So that also contributes to higher rents, as well as the better occupancy situation. Also, yields were like in the dry 2 years of 23 and 24, or let's say two to three quarters of that year. So from September 22 to September 24, the yields for student expanded in average by 63 points, while the average of the other asset classes and general real estate was north of 100. So student did not expand that much. And the transactions that happened in Q4 24 happened at a yield that is very close or at par with pre-September 22 levels. So the investment appetite and confidence is obviously stronger than in other asset classes. There are about 12 strong transactions, which will probably, if they happen in 25, cumulatively represent more than 10 billion. So we might experience as strong of a year as the strongest year in student housing history, which was 2021. So the situation in general has become different. How much this is gonna be executed or a trend, we will see. But with this, I probably would invite our panelists to join me at this virtual table and discuss it and share their experience, their opinions. With this, let me sort of introduce our four very distinguished panelists. Thank you for joining us and sharing your time, experience, and views. And with this, I would like to ask you to introduce yourself very shortly, personally, and the organization you represent, and then when we can dive into the particular discussion topics. So if I may ask with Alicia.
Hello, yes, good afternoon, good morning to everyone. I'm Alicia Edgar. I'm a director in the alternative investment team at Invesco Real Estate. Invesco Real Estate is investment management business. We have approximately 15 billion AUM across Europe, sits within about 200 assets across 13 countries. 30% of that roughly sits within living, which is sort of majority residential and hotel. But in recent years, we have ramped up our exposure to PBSA. Our first entry into the European PBSA market was back in 2018. But I'd say in the last 18 months or so, we've secured approximately 250 million, around 2,000 beds, either closed transactions or secured pipeline. Thank you for inviting me today, and great to be a part of this discussion.
Likewise, welcome. Joe?
I'm Joe. I'm the Chief Operations Officer for Yugo. Yugo is the global brand and operator across 13 countries and around 80,000 beds now, and continually growing, which is nice. Really pleased to be part of the panel, so looking forward to the discussion. Thank you.
Thank you. Pavlos?
Hello, everybody. I'm heading up the European Living team at Hines. Hines is a global private investment manager and real estate developer. We're fully vertically integrated. And similarly, in Europe, as part of Living, we have close to 13 billion in terms of gross development value. About a third of it, a little bit less than a third of it, is in student housing. Operational, we have close to 8,000 beds. It is in UK, Ireland, Spain, and Italy. We recently launched the platform in Paris, and probably in a few years we will be a little bit less than 50,000 operational beds.
Thank you. Jonathan?
Well, good morning. First of all, thank you. As Elise said, thank you for inviting us and allowing me to participate. Harrison Street is celebrating its 20th anniversary as an alternative investment management company. We've only ever focused on alternative real estate and real assets. We've never been one to play in the core four. We are the second largest owner of student housing in the United States. We are a major player in the European market across a broad spectrum of assets in the UK and in Western Europe. The Canadian office, which I oversee and run for Canada for the firm, we're celebrating our 5th anniversary this year. We've been very active in the student housing space over the last few years and built up our portfolio in a very small market, in a very small time, where our closed transaction, committed construction, and committed deals is in excess of 1.1 billion, which puts us in a top 3 type of position in the Canadian market.
Thank you. If I calculate correctly, here in the room we have people and expertise that has influenced more than 100,000 beds and several billions of investments and divestments. So I truly appreciate that we have this opportunity. And before we dive into questions, I would like to encourage the audience to post questions, ideally through Q&A button on sort of bottom part of your screen. And our team, who is kindly helping me to collect the questions, will funnel them down to most important ones or most interesting ones. And then I will ask the panelists those questions we will have time for in the course of conversation. So with this, maybe easy round of simple question. When in 2024 did you start to feel the change of the sort of investment mood? What triggered it, and how did it manifest in your operation? So if we can start in the same order, that would be fine.
Thank you. I think, in terms of when did we see it within 2024, it was perhaps partly behind that period, and when we sort of recognized the opportunity within the sector, within the asset class. Arguably, market conditions were probably less attractive to ultimately deploy capital prior to then on both sides. As far as sort of seeing the turning point for the opportunities for us, it's really when it started to become more institutional as an asset class. I think we all know that the UK market has been that way for many, many years now, but outside of that, continental Europe has taken a while to catch up. But we took our first venture into the Spanish market back in 2019, and that subsequently traded out of that. But we're seeing more and more sort of institutionalization of the asset class, driven predominantly by the growth of the international student numbers. I think we've seen an uplift in English taught programs in the last 4 years by circa 20+%. And I think that really has driven, and exaggerated the supply-demand imbalance and some of the macro drivers of the asset class, which have always been there. It's always been a sort of appealing class for investment for Invesco. And then it really was actually probably a combination of factors that led to the ability to unlock some deals, probably Q2 in 2024 for us more so. But I would say, as many no doubt on the panel will also witness, these things don't happen overnight, and they are sort of very granular in terms of their transactional sort of characteristics. So it takes time to arguably close, but I think we've had the appetite there. It's just been a case of actually unlocking the deals at pricing that makes sense for both sides, and that's probably flowed through the course of 2024, where vendors have actually realised prices have adjusted, and now's the point to execute.
Mm-hmm. Joey, I assume as you are so distributed across the continents and countries, was it the same? The investment confidence and unlocking the capital, or it happened differently by region?
I think there is a degree of regionalisation to it, but I think generally I concur with Alicia in that the end of Q2, beginning of Q3 really was when we started to see a lot of activity back in, and specifically core money starting to look at opportunities again. I think we'd experienced the tail end of the denominator effect and the diversification of portfolios across various institutional capital. And I think it was aided by the resurrection, if you like, post-COVID, of hotels, retail sector starting to come back a bit more, which then helped, certainly inadvertently, the student sector and the living sector, which had always had high demand, but as Alicia mentioned, very difficult to unlock in the financing world and the environment that we were in. So we really saw a lot of activity middle to end of last year, with a lot more inquiries, a lot more people interested. I think there's always the challenge of construction costs and trying to make a scheme stack up, and the question of affordability and what's the right rental levels, etc. But certainly activity has ramped up significantly, and across most countries, to be honest with you. I think it's come back. There's still, and I'm sure we'll discuss later on, still a bit of umming and ahhing in terms of the political situation across certain countries, what's going to happen with Trump, for example, legislation that is being threatened and either coming in or not coming in, or is coming in but then isn't, and what happened in Ireland, for example, with the 41-week leases. So there's still a bit of uncertainty out there, but I certainly feel more confident in terms of the capital and the type of capital that's looking to come back into the sector, because, as Alicia said, the underlying fundamentals remain strong.
Mm-hmm. Pavlos,
I would really echo Alicia and Joy. I don't see a turning point. I see a gradual growth in the appetite, and it's very representative to the chart that we saw earlier. I think the first turning point was after COVID, that we realized that the sector is much more resilient and that people will return into student housing. If I had to choose a turning point, it wouldn't be within 2024, would be a couple of years earlier. And then gradually, with the changes on the capital markets and making the living sector much harder to invest with negative leverage, student housing was living, resilient, allowed for rental growth, good quality, was really coupled with higher returns in terms of this rental growth. So gradually there was more and more appetite, and of course the institutionalization is a story of, again, maybe a little bit more than 5 years. Within 2024, I would really agree, but in order to be active in Q2 24, I think that you needed to be active, and I think this was mentioned already, you needed to be active in 2023, not even in the beginning of 2024, and for us at least, this was the case.
Mm-hmm. And Canada?
I don't want to sound like I'm repeating what everybody said, so I'm just going to stay silent on that. I think over the course of Canada's been slower to develop from an operational standpoint as well as from a transaction standpoint. That's obviously one of the opportunities we like about it. But I would say over the course of 2024, there was just a consistent introduction of new names into the space. We saw some of the US operators start to come into the marketplace and start to put their feet in the water. We saw an Australian operator come to market. We've seen developers from Australia, from the United States move into the marketplace. We've also seen some major Canadian pensions investing in the space. And so there's been a general build up over the course of 2024 that did separate it, I would say, relative to prior years. I would agree with Pavlos as it relates to, I think the real turning point was a few years ago, post-COVID, 1000% agree. But I think in Canada, we've just seen that constant uptick over the course of 2024 that sort of bolstered and put us in a position where we think 2025 is going to be, another good year from an operational, from a transaction standpoint.
Maybe a bridging comment and question, whoever wants to take on it. When I was presenting at the US Student Housing Conference back in October 24, then the audience had a little bit of hope that Trump will be reelected because there will be more investments and less regulations. So I'm heading to a question: what do you think that is going to happen around this development, as well as an ECB announcement with a commitment to bring the interest rates down to 2%, so very rapid, sharp decrease. So with this, the question is that are we going to see even more transactional and investment activities than we see now? How high are your hopes for 25?
I can give it a go without making any political statement or comment here. I think there are two. I think there are two reads. The first one is, where the demand from international students will be headed if visas are becoming harder, and we saw already, and this was mentioned about the UK. When visas are becoming harder, more expensive, or anything else, the international students are heading towards other markets. If UK is harder, people will study more in Paris, Italy, or the Netherlands. Similarly, if less international students go to the US, there are a few alternatives in Europe. The other read is if the tariffs are going to be applied, there might be a domino effect with a little bit higher inflation, which will get us back to where we were maybe 18 months ago. So we don't have a crystal ball, but there are a couple of reads that can affect directly the student housing sector or the whole rental sector. So I think we need to wait and see a little bit more. It's early.
Mm-hmm. Yeah, I agree from the standpoint very close to the United States. The last time Trump was in power, obviously the visas, student visas issued in the United States declined dramatically, and I would say Canada was a great beneficiary of that, where we saw multiple years of 15 to 20% increase in international student visas. And so it's unclear how that's going to play out. He also, restricted a lot of the H-1B visas historically, but now it appears as though there's a possibility that will be, pushed through in a more positive light. So it's unclear to us how it's going to play out. Fundamentals still remain strong within the Canadian market. We are not dependent from a student housing standpoint on the international students. Over 85% of the residents in our properties are domestic students, given the manner by which the domestic students go to universities. They don't just go to their local town, they actually go abroad provincially and within the province. And so we have this strong base of the domestic student population that could offset some potential international disruption, either increases or decreases. And we're seeing that given that growing population base. Unlike the United States, Canada does have a growing population in that 15 to 19 age category that's going to provide long-term support from a domestic standpoint. So from our perspective, all we know is there's going to be volatility over the next few years. We have our own volatility from our own federal and provincial governments that have been thrown into the mix here. But the underlying fundamentals are what's strong at a domestic level.
Before I go to occupancies as a next topic, I would ask my colleagues to pull out the first polls and let the audience vote on their status quo. So if I can ask to pull out the question, what level of occupancy did you record in autumn 2024? Okay, so while you do that, if I can ask the panel, so how did the sort of 2024/25 academic year play out for you? It's in some countries we heard that might be affected by regulations, but on the other hand, for example, for the UK, what we are hearing for 25/26 is already stronger. So maybe Joe, you are probably having the most bets under management and operations. So if you can comment on that.
So I think 2024 in general was a good year. There's obviously nuances by country. We were thrown a curveball in Ireland, for example, when at the last minute the 41-week tenancies were coming in. But we got there. I think it does vary by market, and we do notice that year on year there are slight shifts in markets in terms of how they lease up, whether it's through the pace of lease up, the types of contracts that people are looking for, as well as the type of student that's looking to study in those countries. So generally, I'd say we hit our numbers and occupancy was strong. It was probably tougher towards the end of the cycle. In the UK, for example, clearing wasn't as big as it normally is. You expect a huge surge in August, but I think some of that demand had been pulled through earlier on in the cycle as universities gave a few more conditional offers and unconditional offers across the UK, but generally, very, very good. I think the start to 25/26 has been mixed so far. So you said the UK is strong, and I absolutely agree. I think the full impact of Ireland and those 41-week leases versus the 51-week, we're seeing a slower uptake there. But that's not to say that we won't get there. It's just, I think the impact of that new lease type has sort of thrown the cat amongst the pigeons a little bit in terms of our strategy for leasing up. But for example, in Spain, we're seeing fantastic. We leased earlier than we've ever leased before. Traditionally in Spain, we were starting the leasing season end of Jan, beginning of February. We went earlier this year, and we've already seen the benefits of that as we've seen more and more students, despite Spain starting, or actually quite rapidly moving towards a semesterized basis rather than a 51-week tenancy. We're seeing more and more semesters coming through and demand for semesters. But even launching for 25/26, we've seen some really good uptake there. And then the other one that I'd mention would be Australia. Hopefully everyone's aware of what's been happening in Melbourne as probably, if you want to pick a risk market, Melbourne could be the risk market, as we've seen talk of visa caps being put into place, then being voted down in government, and therefore not being pushed through in this term until the new election happens, and then we'll see what happens after that. So Australia has been slower, or Melbourne in particular has been slower versus prior years. There's two reasons. One is the visa cap situation, because when the decision was made not to push that legislation through, the question was then, was that decision made too late for those students that were already looking to book in Australia, and have they chosen elsewhere to study? Or would that demand come through? We got notification from the government that they were going to prioritise student visas in terms of approvals of applications to speed that through. So we're starting to actually see that come through now as the number of applications from internationals increases. But Melbourne's also subject to a lot of supply that's gone into that market over the last 2 or 3 years. So put those two together, and it's a slower market. We're still confident that we'll get there, but just not as early as we have in prior years.
And maybe I'll ask the same, Pavlos, as you have many beds across the countries. But quick question, Joe, what uptake you have for single studio or single ensuite versus shared rooms? Is it the same? What do you feel is the trend?
Varies by market. Really does vary by market and by type of student that is attracted to the properties. I mean, we've got an array of offering from sort of basic rooms, if you like, right through to the high-end premium rooms. We try not to dabble too much in the premium. That's the higher risk environment. But I think there was, during and post-COVID, I think the thinking was that studios would just take off. People wanted their own rooms, and that would almost signal the death of en suites. And we haven't seen that. I think we've seen pretty level sales and leasing through both types of room in their basic forms. But it does depend on the product, the market that you're in, the demand, all of the external factors in terms of supply that really can skew the numbers. So if you've got heavy studio product, but you're selling well, then you think that studios sell well, but it just depends on the micro location you're in, what the offering is, your price point, and all those other factors. But I don't think there's a noticeable difference across most countries in terms of which room type sells quicker. Obviously, if you're skewed towards domestics, and in the UK as the example, that are used to potentially pegging rents versus HIMO, then you may see a higher propensity of ensuite selling through quicker than studios. But the UK, as we know, is slightly different to the more immature markets in Europe, especially.
Pavlos and others, if you want to take on this.
My view is not very different. So I would just highlight. I completely agree. Depends on the market, depends on the product. People thought that twin rooms would never be in demand, and we've seen markets that twin rooms was something that we shouldn't be touching, and then we see that they are the first that filled in because the pricing point is so much more attractive, and still the experience by using the same amenities and being in the same location is much more important together with the pricing point. So it's a little bit of matter of pricing elasticity, and we've seen some occasions that the most expensive studios fly first because there is a little bit race for the best units and for the quality. This doesn't mean, to the previous point, this doesn't mean that if we were to do 10 times more expensive studios, this would continue to fly. So I don't think there is an applicable rule. It depends on which is the target university, the target student, the quality, the pricing point. So I think there's not distinct answer to this. And again, I'm echoing Joe's point about occupancies were high. It took a little bit longer, and it was a little bit harder. And I would also echo that Spain, we see much more flexible lease terms or duration needed in order to fill in the beds. I think next year, and I also think this is an horizontal observation. The more institutional the product becomes, the more competition there is. So there is a little bit more flight for quality. There is more marketing needed. There is more patience needed, and we've also seen a little bit of slowdown in the UK for the next year.
Before I let Alicia and Jonathan to comment on occupancies and product preferences, maybe Goras, if I can ask to show the results of the polls. Okay, so about 59% are close to full, 96 to 10%. Few people are even having waiting lists. Then another 26% is 91 to 95%. So basically 75% of the respondents have occupancies north of 91%. So just for reference from last year, the 96 to 100% was also the most frequently asked for, in the polls. So the market remains stable, or like more than 100% is not that much to grow, but that's pretty comparable. Alicia or Jonathan, do you want to comment on occupancies and product preferences?
Yeah, I mean, I was just going to sort of touch on Pavel's point and Joe's point on just from the ways of approaching it slightly when you're looking cross market, and we say it all the time, but it's so localized, the PBSA sector across each market, and even within country, it can be very different in terms of looking at that revenue sort of profiling, and whether it's semesters or 10-month contracts or 12-month contracts like the UK market. And I thought what was interesting on your report, one of the slides, just how that sits across continental Europe is quite varied versus other markets where you can pretty much black and white say you're going to be getting a student on a 10-month contract or 41-week lease or whatever. It's much more operational. It's much more weight driven on your business plan and your operator partner with regards to how you're approaching your price point and how dynamic that can be throughout the life cycle of the investment or throughout the academic year. So I think that's really important to us, and navigating through that can be complicated. But I think it just shows that there is no one size fits all really, particularly in continental Europe with regards to the approach. And it's becoming more competitive as we see it.
I would just reiterate what everybody's saying. Every market is slightly different. Obviously, although we're just in Canada, we have massive regional differences between markets like Montreal, Toronto, Vancouver, Calgary. They're all very different individual markets. The universities are set up in a very different manner, ones that foster community atmosphere and multiple kids coming out looking for a 4-bed suite type of configuration versus those that are driven more towards the studio side of things. And so every market is slightly different. I think one slight nuance is obviously from a competitive dynamic, we just aren't as developed as others. And so, we feel very confident around our continuation of these high occupancy levels. I saw Canada was at 98. We were at 100% on all of our assets last year. And, given the lack of competition and that supply demand imbalance, I think, we don't envision any major changes within the marketplace, although certain markets are a little more price sensitive than others. But at the end of the day, again, it's just such a young market that there's not much data to drive us in any one direction or the other.
Mm-hmm. Okay, I just received a cumulative of all the questions, about 50 there in Q&A and chat, so I'm selecting some, but let's move to rents. And Goras, if I can kindly ask to pull out the polls on rents. The question is, where do you expect the rents to be in September 25 compared to last year, so 24-25 levels? There is a mistake, sorry. So September 25 rents versus the previous September rents. So while the audience will cast their vote over here, there is a question perhaps on let's say the rents increased more than 5%, a little bit less than previous year, was 6.7%, I think, in general. But it's still less than disposable income of the parents and less than the private rental market. So are we confident for 25? Where do you see the rents next year? Are we going to have a fourth and fifth strong year as so far? Or it will be a little bit hitting the affordability issues? Because just one more comment, most of the reasons why the rents increased in previous 2 years was the OPEX, not necessarily the demand. So the operators had to increase to balance out the increased cost. But now we will see less supply coming to the market, more students coming to the market. So actually that might be the main reason to rent increases. So if I can sort of invite for reacting to rents, that would be appreciated.
I mean, I'm happy quickly on the Canadian side of things. I mean, first off, I would say the rent increases in Canada haven't been driven as much by the OPEX side of things. We've been pretty flat. We had a surge in insurance costs a few years ago, but it's eased up over the last few years, and property taxes have eased over the last few years, oddly enough, in Canada. But so I would say, the growth has really been driven by that supply-demand imbalance. I think our expectations right now are we're going to see approximately 5 to 7% growth in rents. But you have to bear in mind, in Canada, we do live in a rent stabilized environment, typically attached to an underlying lease. There's those that are staying within a building. We're only able to increase the rents by 2.5%. So with 50% turnover, you're looking at with a 5% rental increase, you're looking at, closer to 7-8% growth rates on the new tenants coming in. And so we think in that 5 to 7 range is probably appropriate. I would say that we are starting to feel some pressures as it relates to affordability. Samuel, I agree with you that, relative to the earnings power of our tenants' parents or sponsors, in Canada, we've seen a little less GDP per capita growth than some of our peers. But I would also highlight that in Canada, we're in an awkward situation where the cost of rent is more than the cost of the education. And so there's a sanity check issue that's impacting a lot of the domestic parents when the cost of sending my son to school is $6,000 Canadian or $4,000 US, yet the cost of housing is 10,000 or more. At some point, some people push back. And I think we're in a little bit of a plateau right now within that needs to be worked through. That's one of the big issues that we think we need to think through and deal with over the course of the next 12 to 24 months.
Mm-hmm. Let's pull out the results before we go to other comments. So the mood of the audience is that the rents will increase in a zone of 3 to 7%, which is the same predominant answer than last year at this time. So the market is similarly confident in rent increases, so not less, not more. That's probably a sign of not significant change either direction. But if Alicia or Pavlos or Joey want to comment.
Alicia.
Yeah, I mean, I think what's interesting when you look at where I think, typically it's driven also by the supply-demand imbalance, generally speaking, as well as obviously the increase in utility costs and operators trying to offset that. I think there is an affordability story that must not be sort of missed. And I think that's when, as the international student profile has more choice in where they want to go and study, that will come into perhaps part of their decision making. Now there'll be the top, quartile that it won't be a concern, and they'll be spending thousands on their course education, so it's not a bother, or actually their parents will be paying it, and it just doesn't even come into question how much it costs them for the rent of accommodation. But I think as there are, there's going to be more flexibility, more choice for students, particularly the internationals, but equally the domestic mobile, that they'll start to look at markets where they are perhaps more affordable, or there's incentives in place from those local countries. We know that France is particularly attractive in terms of the concessions that are on offer versus other, and also the UK in the London, the latest sort of London plan, requiring for more affordability in the planning stage for that to unfold, to create, more accessible with regards to the affordability of the rent for the students. I think that's where we always need to sense check, what does it look like versus alternative accommodation in that localized marketplace. So what is the residential rents? What is, co-living? Where do we sit as a kind of mark to market prospect? And I think for us, part of the approach is always ensuring the depth of demand is going to be there. So you don't want to be the most expensive in your local market, because it'd be a small proportion of students willing to pay that amount. But notwithstanding that, I think we will see, and even talking to others in the marketplace, where they sort of like uncomfortable underwriting rental value growth forecasts, say 5 years ago. And now you look at those prices to where rents stand today and think, gosh, why was I, why wasn't I comfortable taking that forward? So I think it's always part of the equation when we come to analysing rent levels. And I don't think it can be forgotten, but I think we still will see some strong rental growth upticks just driven by those macro market drivers and lack of stock.
Mm-hmm.
A bit less optimistic for the next year versus the previous year versus the previous year. I'm not saying that there will not be rental growth, but I think we will see the decline. And I think what Alicia mentioned about the alternatives, it all grew very, very much in the high inflation where the rents also grew significantly, and in an environment that people cannot afford to buy, they're turning to the rental market, and the residential rents are growing. And student housing, of course, is probably the best option. But if the second alternative is not growing that much, there will be a little bit of a plateau. So even if the poll says exactly the same, 3 to 7, probably last year it would be closer to 7, and this year will be lower than 7. For example, the UK last year we saw double digits. I think maybe we will be high single, depending on the market. I'm generalizing, but I'm trying to describe the trend that I believe that we will observe for the next 12 months.
Joe, you want to comment or we move?
No, I echo that. I think you're absolutely right. It will start to plateau. I think we've been through the bubble post-COVID of trying to catch up on rents, and we're seeing costs that are stabilizing, whilst not to the levels they were previously. They're not increasing by as much. And Jonathan touched on that, and things like insurance. It's not just utilities, but insurance and property taxes have a big bearing on OPEX. And if I look at the scale of 3 to 7, I look at it on an aggregated by country basis, and I'd say that if we got the US to 5, I think that's a good result. If we got 7% in Australia, that's a good result. And then all the countries in between, if we're getting around that 3 to 5, depending on the country, then I think that those are sort of realistic expectations. Obviously, there will be outliers depending on the market situation. But I think the really good point to raise is, when we look at demand supply, and Alicia and Pavlos have touched on this, but we've got to look outside of PBSA. And that's where your rental levels, you really need to be pitching, not just against PBSA, but against the co-living and the BTR product that's out there, because the closer your rents get or surpass, then that becomes a realistic option for students, not just international, but domestics too. And we just need to be conscious of what's happening. And I think that's why it's enmeshed in that whole political football of, do we have rent controls? Do we not have rent controls? What's the minimum leases? When can you exit a lease? Is it 1 month notice? All of those factors really tie into the performance of your asset and your portfolio, because that adds uncertainty, and ultimately capital investors want certainty of outcome. For years we've been trading off capital return, and investors looking at total returns, but you've seen capital appreciation. We've obviously seen that has dropped off, and it's all about rent increases and how you can make up for that shortfall as we start to see cap rates maybe tighten slightly and become more favourable, as well as the financing. I think you put that all together, and suddenly you've got that balancing of total return, capital return versus rental levels, which become a bit more important now than it would have been over the last 3 or 4 years. So it's a real hodgepodge of many different areas that you need to look at and take into account. But I don't think it's going to be a pessimistic year by any means. But as Pavlos said, it will be slightly more subdued versus prior years. We can't keep growing at Glasgow's double-digit 20% growth rates. Not every market is Glasgow, for example. And also subsequently, Leeds can't be in the situation it's in now with the 2,000 plus BTR beds that have gone in that have impacted that market. So, it swings and roundabouts, but in the main, I think the 3 to 7 is the right place to pitch it.
Yeah, just to comment, what do we see some of the strategies of operators that they try to increase length of the contract, as Martin presented. So that helps to sort of increase the occupancy. Some of them even have a financial occupancy north of 100% because they rent the room for the shorter contracts, let's say when there is a vacancy. Also, besides the longer contracts, so they don't sell so much 5 and 10 months contracts, but they also increase the repeated ratio. So in pre-COVID times, it was pretty normal to have 35% of students to stay. So the average length of stay was 1.3 years, but we see more and more assets to have students 2 to 3 years in the asset. And then this way they increase the rents less so, but they save on the marketing costs and let's say maintenance. And this way they reach the same NOI they need, even though they don't increase rent so much. So also affordability hits by putting more shared rooms to the market, just to balance out in case the market hits the affordability. So these are some of the techniques we see. Let's go to investments and transactions. So if I may ask Alicia, and then others, what is your outlook for transactions investments in 25? Do you anticipate more activities than in 24 or even more than in 21? What do you think it's going to be? How liquid is going to be the 25?
I mean, yes, I do anticipate more than 24. And arguably it could be up to 2021 or sort of overtake 2021 volumes. There is notably a lot on the market at the moment. A lot of that sits within the UK, which is not surprising. So it'll be interesting to see how that lands in 2025, particularly some of the large portfolios that will be closing imminently, I would say. I think in terms of sort of outlook for 25, so as I mentioned, UK, I think that will be quite a lot of transactional volume potentially coming in the first few quarters. I also think continental Europe perhaps will be driven more by development transactions, just because of the nature of the marketplace, but there will be, as potentially, whether it's next year or the year after, some platform trades, and even as your point previously was made, maybe we'll see some M&A activity as well, or more of that activity come through, because it's still it's very mature. Maybe it's not quite 25 outlook, maybe it's slightly later than that, but I think we are seeing, extreme fragmentation in continental Europe on the landscape of the operators and the players, and that's perhaps got to consolidate at some stage. So yeah, I think we will see the driving force of transactions being development deals in continental Europe, and actually I think it's going to be interesting to sort of hopefully see some different inflows of risk profile and capital appetite coming from across, the core money slightly coming back. We saw GIC trading last year in the EQT Spanish portfolio. I think Australian Super entered the UK market last year, more of a development deal, but we'll see some of that more kind of core plus capital come back in, which would help support transactional volumes.
Mm-hmm. What's the experience of capital raise recently with the other panelists, if I may ask?
Go ahead. Oh, okay. I mean, from a Canadian standpoint, our capital base of our flagship fund in Canada grew 75% last year, which we allocated the majority of it into the student housing space. Our expectation this year is that our capital base will grow another 50 to 100%. And so the capital is inflowing, both domestic and international. And so our expectation is the capital will be there. But, building on what Alicia said as it relates to transaction volumes, I think last year was a record year in Canada. We had over 2 billion of transactions done, the majority of it in just a single transaction. And I think this year, obviously, we're not going to get close to those numbers as far as the scale of transactions, only because there's not that much out there to do. I think the demand is there, but the reality is it's such a new market, there's not much available. I do think you'll see a larger number of transactions, but where you'll see the capital flow in, that which is interested, the majority will flow into new development, just given the lack of product in the marketplace. So I think we're less transaction oriented and more new build oriented from a capital allocation standpoint as a country.
Pavlos and Joe?
We do invest through our open-ended core fund, our open-ended core plus fund, and our third in the series of the closed-ended value-add funds. across all product types, and definitely student housing is on top of the priorities. Last year, we did about 1.5 billion in terms of real estate value in the student housing. I believe that we want, and we will probably do more next year. And I think the more the core capital coming back to being available and to provide liquidity, there we will see more transactions generally. I think even the allocation of capital in the living sector from the discretionary capital that we have is not enough for the projects and the opportunities that we will see. But I see much more demand in 24. I saw much more demand in 24 versus 23, and I expect 25 will be there. And assuming that also the capital markets conditions are allowing to be a little bit more optimistic about the probability to transact, I think there will be more there in the market.
Okay, Joey, your take.
My perspective, I concur with Alicia. I expect to see a lot more of a consolidation play coming through. And that's from big portfolios through to smaller portfolios from private equity. We've already seen a few that have hit the market already, and that's testing the waters. And we put that together with core capital that's starting to turn their heads again and be interested in core plus. I think there's opportunities there, so we'll see a bit more of that. And I think that with the way finance is going, and hopefully base rate cuts continue, we will see more new interest or more capital looking to enter that has been sniffing around for a long time, but have struggled to had to take the time to understand how the markets work and how student housing works across the different markets, but also how they want to enter and with which type of fund, with type of capital. What's their cost of capital? What's the best return for them? And is it a value add play? Is it buying some older stock, Gen 1, refurbing, rebasing the rents? Is that a strategy, or is it buying something new and getting the core? And so there is a lot of dry powder out there, but it's just how best to deploy it to give them the best returns. And again, it depends on whether they're long-term or shorter-term players. But I see it as very positive. I think there will be a lot of activity, and it will be throughout Europe where you have got portfolios, but you will have smaller 2-3 asset private equity type transactions coming as well.
Just a very short question from the audience. While it might be obvious to you, but not to everybody, why is student housing more attractive investment asset class than the other? Like most of you raise capital for multiple asset classes. So what makes student so different or better? So whoever wants to take.
Because Alicia, John, and Pavlos say it is. That's why.
I think combines good risk-adjusted returns. So it's resilient, if not even counter-cyclical, with the demand for student housing in bad times growing. It's less regulated, and it feels that it's also correlated to quality. So the more quality you can do within reasoning, there is correlation with the success of the business plan. So less regulation, lower risk, and potentially higher returns. So I think, and a little bit of fun, being more creative and creating a product for the younger generations. So if you combine all these four, I think it's great.
I agree, in particular with the last comment you made, Bill. It's good to invest in things that are doing good, and allowing the next generation to be the best that they can be by providing them a safe, secure, and a community environment to learn in a very difficult time in their lives. But I think the biggest thing for us is we think that there broadly is an overestimation of the underlying risk attached to this sector. Once you get into the sector and once you operate within the sector, you learn how to manage some of the risks that others may be frightened by, be it the turnover risk or other factors. And I think once you dig into the sector and you appreciate working with a high quality operator, as many of who were on the phone, once you start working with a quality operator, you understand and can appreciate that risk profile, underlying risk profile, is not as dramatic as maybe the outsiders think. And as such, we think there's a risk reward imbalance to the benefit of student housing. And if you team that up in an environment where there's less competition, searching for and attacking that space, and therefore the valuations are, unattractive. It's a very powerful combination of buying at an effective price with a lower risk profile once you get to understand the sector. And as the sector has become more institutionalized and grown over the years, certain markets, that alpha has sort of dissipated a little bit. But if you're a quality operator, quality investor, you can find those. That's what we're paid. All of us are paid to search and to find. And I think that's what makes this an interesting opportunity relative to a lot of the other sectors, which I'm not saying negative things about our other sectors. We're very excited about the other things that we invest in. But this one definitely has a high conviction point for us as a firm, globally as well as in Canada.
Before we go to last,
I was just going to say, you articulate it so well, Jonathan, but I think it's also proven its resilience at this point in time. We've gone through quite a game-changing macroeconomic environment, and I think it's given everyone a lot more comfort, which enables its liquidity, because it has proven that performance, it's proven its resilience. And there's still a lot of room to grow. There's still so much more scale that is on offer, and growth in that performance it is on offer. So that's why it sort of perhaps sits above the rest. But we still like other alternative asset classes and other core asset classes.
I will go to last question, but Goras, if you can pull out the last polls on yields. We are being asked by many to ask this question every year. So where do you expect the exit yields to be in 2025 onward when you compare it to pre-September 22 levels? Example, Paris was on 425 pre-September 22. So where do you think it's going to be in 25? Is it the same, or is it going to be up to 50 bips north, or even more expanded, or the other way around, that the strength of the capital and liquidity will be so strong, then the yields will even compress below the level of pre-September 22. Your opinions over here. But in general, I can comment that we experienced the same. So more core capital coming, so weight of the greater tickets, and also sort of more demand for students, where the investors can work flexibly with the rents every year, not only with the indexation of inflation, and also a greater demand for living sectors or rental sectors. This all can, all together with lack of supply and more students, contribute to more overall demand, and probably that smaller expansion of the yield in student and other asset classes might be also mirrored in 25 onwards. So, Goras, do we have results so that we can move to last question? Okay. So we have less of a crowd now, but that voted. But more than a half, 64%, is about same as September 22, or expanding no more than 50 bips. So probably means a little bit more of a compression to where it was in Q4. So last question, which cumulates a lot of questions from the audience: where to invest? So what is a good product? What is a good market? What is the good geography? Is it single rooms or shared rooms? I know it's very general, depends on capital and geography, timeline, IRRs, or yield game. But so what is a good geography and product to invest in student housing? And if you can give as concrete answers as possible.
It will be fast, but not very concrete. So I think aligning investment development and operations, which means having access to a student pool and the quality of the product to be aligned with the pricing, there will be demand. So we can see very, very high quality, expensive. We can see, less amenitized and lower pricing points that still they are 100% occupied. So it's not one thing. It needs, for me, it's all about the alignment. So very fast, but not very concrete answer.
May I ask the other panelists?
I think for us, it's the sort of, the drive to quality. Again, multiple layers will come into the best product, or what defines the best product. But I think location does, and I say that with regards to sort of the location vis-a-vis a student perspective. So higher education institutions, quality of location will be one of our top drivers for investment and product quality. We haven't really touched on it on this webinar, but for us as well, investing in assets with strong and robust ESG credentials and operating, being able to capture and collect that data for driving operational performance is key. It's where it becomes very complicated in looking at conversions or looking at sort of repositioning plays in the asset class, but location would be my driving force, my top.
I think I would reiterate what everybody else has said. I think if you want to push me, Samuel, as far as location, I'll say Canada. But all joking aside, I would say there are a good number of, first of all, we will only focus on the major universities. We think there's still too much volatility amongst the colleges and others. And so we're very much believers in you have to target the larger universities, which have a more consistent growth pattern of underlying enrollment and better sustainability during difficult times. There are certain markets where you've seen an under-penetration of student housing to date. There is one market in Canada which has, probably 30% of all student housing. And I think that's going to come under some pricing pressures. I think going into the newer markets, markets like a Calgary, a Montreal, a Toronto, a Vancouver, huge city centers, but at the end of the day, under-penetrated, I think is going to be the key from our perspective. As it relates to configurations, we're leaning right now in the major city centers towards some micro suites as a unique product and a way to keep it affordable by increasing the density per square foot of new build, which given the construction costs in Canada, land costs, we think is critical to long-term return thresholds. As well, though, we think that there is an affordability concept that I talked about earlier within the Canadian market. We do think that there is some slightly older product that you're able to purchase at a substantial discount to replacement value. And we think strategies looking at some of those older products and enhancing it, sort of a little bit what Joe said in one of his comments, taking an older product and upgrading it and bringing it to today to a degree that you can, I think is going to create an affordable product that's going to compete well and provide well into the marketplace. So we are very much focused on those types of strategies as well in the near term.
Thank you. And we, Joey?
And from my perspective, I'll answer the question. I'll stick my neck out. And I would say if it was my money, I'd be investing in the US, Portugal, Poland, Australia, and Italy as my primary countries. If you want to know which cities and which micro locations, you'll then need to talk to me directly or sign up to BONARD's platform to find out more. But they're the markets that really pique my interest at the moment in terms of opportunity, where cap rates are at, availability of capital, availability of products or land to be able to develop on, and be able to get scale. So they're my tips for 25.
Thank you. And with this and the time expiring, I want to appreciate your time, expertise, opinion. I would like to also remind the audience ability to sign up for 14 days free access to our platform. And also there is a free sign up for Market Monitor, daily news on student housing, all the transactions. So that can be done on the website as well. And the presentation, the deck, as well as the recording will be sent to you later this week. So thank you for coming for the panel. Thank you for the audience to come. Not all the questions could be answered, but hopefully this was useful. I saw also people connecting in the chat. That also is nice. And also good to see some people and names in the audience. And thank you for all the appreciation that we received in the chat. And we will sort of continue delivering the useful data, as Joey said, for your decision. Thank you.
Thanks, everyone.
Thank you.
Thank you.
Thank you.
Thank you.